So first of all, as I said, starting with what do we actually mean when we say an employee share incentive? Well, essentially, I think it involves providing employees with the opportunity to acquire shares in their employer company. And if they're in a group of companies, well, then in their a company within that employer group. So there's an essential connection between the employee or the individual and the place and environment in which they work. It can be a formal plan that involves a number of employees across the company or group, or it can be just a single award to a single individual. Also, we can give the shares at no cost to the employees, or actually it can involve investment of their own funds. At the simplest level, it could be allowing an employee just to buy shares in your, say, private company, or it could be a global plan that involves thousands and thousands of employees across the world. So from a general position, I think we do need to think about tax as part of our design. So fundamentally, if the shares have been acquired by reason of employment, that's very wide definition, then they will be taxed either as general earnings under Section 62 of ITPA, or more likely, and because it applies in priority, Part 7 of ITPA 2003. And within Part 7 of ITPA, it's the shares that are given to employees or purchased by employees are referred to as employment-related securities. Now, employment-related securities within the legislation is much more wider than shares. So it includes interest in shares, any kind of securities, warrants. I think the only thing it doesn't include is sort of cash deposits such as checks and some insurance contracts. Okay, so the other thing that we just need to think about is the potential for transferring employers' national insurance. If national insurance does arise, because it is a readily convertible asset, it is possible in certain circumstances for the employer to take over the employer's secondary class 1 liability. And this includes, it's not widespread by any means. So it's not the case where we have any national insurance contributions. It's more where we can't really control as an employer when the tax point will arise. And so it covers exercise of options and also certain post-acquisition chargeable events, such as where restricted securities or convertible securities are involved.